The math governing your retirement is no longer a function of how hard you work or how much you save. It has become a function of sovereign liquidity needs. We are currently witnessing a decoupling between the nominal value of your investment accounts and the real purchasing power those accounts can command. A phenomenon that has historically signaled the start of a specific macroeconomic regime. When the yield on the safest government assets remains persistently below the rate of inflation, the system is not failing. It is executing a liquidation process designed to transfer wealth from the private sector to the public balance sheet. If you want to understand why the retirement goalposts keep moving, you have to look beyond the stock market and look at the bond market's plumbing, which is the focus of our analysis here at Finance Saga. To navigate this landscape, we need to construct a mechanism map that explains how wealth is silently transferred. Picture a flowchart with 3 distinct boxes moving from left to right. The first box on the left is the funding source, which in this cycle is excess sovereign debt that is too high to be repaid through taxation or growth. An arrow points from there to the middle box, the intermediary mechanism, which we label financial repression. This is the deliberate policy of keeping interest rates below the rate of inflation. The final arrow points to the macro outcome, which is saver liquidation. This map, debt to repression to liquidation, is the DNA of the current financial era. We will return to this map as we layer in more complexity, but for now, understand that your retirement account sits squarely in the third box. You are the liquidation target. The conventional narrative tells you that the retirement system is broken because people aren't saving enough, or because Social Security is running out of money. These are symptoms, not root causes. The root cause is that the United States, like many developed economies, has reached a debt-to-GDP ratio that makes positive real interest rates mathematically impossible to sustain without causing a sovereign default. In a normal free market, if a borrower has too much debt, lenders demand higher interest rates to compensate for the risk. If the US government had to pay true market rates on its $35 trillion debt pile, rates that exceeded inflation by a healthy margin, interest payments would consume 100% of tax revenue. The government would cease to function. Therefore, the price of money must be fixed. This is where the retirement system transforms from a social safety net into a captive financing vehicle. In 1978, when the 401k was introduced, and specifically later with the Pension Protection Act of 2006, which encouraged automatic enrollment, the government didn't just incentivize saving, it created a massive price-insensitive buyer for its own debt. When you contribute to a standard target date fund, a significant portion of that money is automatically allocated to US Treasury bonds. You buy these bonds regardless of the price, regardless of the yield, and regardless of whether the return beats inflation. You are a forced buyer. This creates a permanent bid for government debt, keeping interest rates suppressed even as inflation erodes the principal. This dynamic creates a divergence between nominal wealth and real wealth that is difficult for the human brain to process intuitively. We are wired to think that if our account balance goes up, we are richer. But in a regime of financial repression, the goal of the policymaker is to ensure that your account balance grows slower than the cost of the liability you are trying to fund. If your portfolio rises by 6% while the true cost of a middle-class lifestyle rises by 9%, you have generated a taxable gain while suffering a real loss. The government taxes the nominal gain, collecting revenue on your profit, while the inflation erodes the real value of the debt the government owes. It is a double win for the sovereign and a double loss for the retiree. This is not a conspiracy theory. It is a well-documented macro-prudential strategy that has been deployed repeatedly throughout history. The International Monetary Fund and the Bank for International Settlements have published extensive papers on financial repression as a tool to deal with debt overhangs. The mechanism relies on regulatory capture, creating rules that force institutions like pension funds, insurance companies, and banks to hold government bonds that yield less than inflation. By funneling trillions of dollars of worker savings into these negative real-yielding assets, the state effectively imposes an annual wealth tax that never has to be voted on by Congress. The tragedy of the modern saver is the belief that the 60-40 portfolio, 60% stocks, 40% bonds, is a shield against risk. In a deflationary world, or a world of positive real rates, bonds are indeed a hedge. They provide income and capital appreciation when stocks fall. But in a regime of financial repression, the bond portion of the portfolio becomes the engine of wealth destruction. It is the concession the saver makes to the state. By holding the 40% in treasuries or high-grade corporate debt that yields less than true inflation, the saver is essentially agreeing to burn purchasing power year after year to subsidize the borrowing costs of the government. Consider the arithmetic of the 4% rule. The standard advice that you can withdraw 4% of your portfolio annually in retirement without running out of money. This rule was back-tested during a specific period of history, mostly the 1980s and 1990s, when real interest rates were high. If you could buy a risk-free bond paying 7% while inflation was 3%, you had a 4% real return locked in. The math was easy. Today, if the risk-free rate is 4% and inflation is running at 4% or higher, your real return is 0 or negative. Withdrawing 4% from a portfolio with a 0% real return is not a withdrawal of income. It is a consumption of principal. You are cannibalizing the asset base. This leads us to a darker realization about the structure of Social Security. It is widely known that it is a pay-as-you-go system, meaning current workers pay for current retirees. But the demographic inversion, the shift from 5 workers per retiree to fewer than 3, is only half the problem. The other half is that the Social Security Trust Fund is required by law to invest its surplus exclusively in U.S. government debt. It is the ultimate captive buyer. For decades, the surplus Social Security taxes paid by boomers were borrowed by the general budget and replaced with IOUs, special issue treasury bonds. Now that the boomers are retiring, the government must redeem those bonds, but it has no cash to do so. It must issue new debt to pay off the old debt held by the trust fund. This creates a liquidity loop that accelerates the need for financial repression. The government cannot afford to let interest rates rise to market clearing levels because it is effectively refinancing its own internal obligations. We are seeing the manifestation of this trap in the duration crisis hitting long-term savers. Duration measures how sensitive a bond's price is to changes in interest rates. For 30 years, as rates fell, owning duration was a winning trade. Bond prices went up, but we have reached the mathematical limit of that cycle. Now savers are trapped in return-free risk. If rates rise to fight inflation, the value of the bond portfolio crashes, as we saw in 2022. If rates are held down to protect bond prices, inflation destroys the purchasing power of the income. This is the checkmate scenario for the traditional retirement model. The crucial takeaway from this first section is that the inadequacy of your retirement savings is not necessarily due to a lack of discipline. It is due to a change in the monetary environment that has turned the risk-free rate into a guaranteed loss rate. The mechanism of repression requires a large pool of captive capital to function. You, the saver, are that pool. But this is not the first time this has happened. To understand where this path leads and how long it typically lasts, we must look at the last time the United States faced a debt burden of this magnitude. We have to go back to 1945. History rarely repeats, but the balance sheet of the United States government rhymes with a precision that borders on plagiarism. To understand the fate of your retirement portfolio, you must look at the only other time in American history when federal debt exceeded 100% of GDP, the aftermath of World War II. The decade from 1942 to 1951 is the Rosetta Stone for our current economic predicament, providing the exact blueprint for how a sovereign nation escapes a debt trap that is too large to pay off and too dangerous to default on. In 1945, the US debt-to-GDP ratio hit 119%, a figure eerily similar to where we sit today. The war was over, but the bill was due, and the government faced a mathematical impossibility. It could not generate enough tax revenue to service the debt at market interest rates. The solution was not austerity, nor was it a miraculous boom in productivity. The solution was the 1940s version of our mechanism map: excess debt, yield curve control, negative real returns. In April 1942, the Federal Reserve ostensibly lost its independence and agreed to peg interest rates for the Treasury. They enforced a hard cap on government borrowing costs, 0.375% for short-term bills, and a maximum of 2.5% for long-term bonds. This was the Fed-Treasury Accord in practice, though the formal separation wouldn't happen until 1951. For nearly a decade, no matter how high inflation spiked, the yield on the 10-year Treasury bond was forbidden from crossing 2.5%. Consider the mechanics of what happened in 1947. Inflation in the United States soared to over 14% as price controls were lifted and supply chains reconfigured. In a free market, bond yields would have surged to 16% or 17% to compensate lenders for that loss of purchasing power. But because of the Fed's peg, yields stayed glued to 2.5%. This created a negative real yield of nearly 12%. If you held government bonds, or the pension funds that were forced to buy them, you lost double-digit purchasing power in a single year, even as your nominal principal remained safe. This was not a market failure. It was a policy success. That massive gap between inflation and interest rates transferred roughly 15% of GDP from savers to the government in just a few years, liquidating the war debt without a single technical default. This brings us to the most dangerous misconception in modern finance, the Volcker myth. Whenever inflation ticks up today, financial commentators and Twitter economists cry out for a Paul Volcker figure to step in, crank interest rates to 20%, and crush inflation just like he did in 1979. They view the Volcker era as the standard operating procedure for central banking. But this ignores the fundamental arithmetic of the sovereign balance sheet. When Paul Volcker took over the Fed, the US debt-to-GDP ratio was roughly 30%. It was a historic low. The government had very little debt, so it could afford to pay high interest rates on that debt. Volcker could raise rates to 20% without bankrupting the Treasury, because the interest expense on a 30% debt load is painful but manageable. Today, the situation is the inverse. We do not have the balance sheet of 1980, we have the balance sheet of 1945. With debt to GDP near 120%, every 1% increase in interest rates adds approximately $350 billion to the annual deficit. If the Federal Reserve attempted a full Volcker-style pivot today, raising rates above the rate of inflation, and keeping them there, interest expense alone would consume the entire federal budget, leaving $0 for the military, Medicare, or Social Security. The government would be forced to print money simply to pay the interest on the money it already printed, triggering a hyperinflationary spiral. Therefore, the Volcker solution is mathematically off the table. This realization is the fulcrum upon which your financial future pivots. The Federal Reserve is no longer primarily an inflation fighter. It has been forced to become a debt manager. The primary mandate has quietly shifted from price stability to sovereign solvency. This means we are locked into the 1945 Playbook, not the 1981. The goal is to keep interest rates nominally positive, perhaps 4% or 5%, so the system looks normal, while ensuring that inflation runs at 5% or 6% on average. This creates the same negative real yield spread that liquidated the WWII debt, just spread out over a longer timeline. Let's update our mechanism map to reflect this nuance. The map now reads: sovereign debt overhang, financial repression, yield caps, saver liquidation. The arrows represent the flow of value. In the 1940s, the yield cap was explicit. The Fed simply announced it would buy any bond that yielded more than 2.5%. Today, the cap is implicit. It is enforced through forward guidance, through quantitative easing, QE, and through regulatory pressure on banks to hold high-quality liquid assets, HQLA, which translates to buying treasuries. The mechanism is more subtle, but the outcome is identical. The systematic erosion of the currency to clear the sovereign balance sheet. The victims of the 1980s were borrowers, farmers, manufacturers, and homeowners who couldn't afford 18% mortgage rates. But the winners were savers, who could lock in 15% yields on risk-free government bonds. Conversely, the victims of the 1940s, and by extension the victims of the 2020s, are the prudent savers. If you did everything right, saved your money and put it into safe assets, you are the designated payer of the national debt. The 60-40 portfolio, which flourished during the falling rate environment of 1980-2020, is ill-equipped for a regime of financial repression where the bond component is guaranteed to lose real value. We must also address the counterexample. Why did the signal misfire in the distinct period between 2009 and 2020? During this time, we had high debt and low rates, yet inflation didn't spike. This secular stagnation anomaly lulled investors into complacency. The difference was the velocity of money and the nature of the stimulus. Post-2008 stimulus went into the banking system, reserves, inflating asset prices, stocks, real estate, but not consumer prices. Post-2020 stimulus went directly into checking accounts, fiscal transfers, igniting consumer price inflation. We have transitioned from an asset inflation regime to a cost of living inflation regime. The disinflationary buffers of globalization and cheap demographics that protected the 2010s are gone. We are left with a stark reality. The government has two choices: default on its debt explicitly, tell bondholders they won't get paid, or default implicitly, pay them back in dollars worth half as much. Explicit default is political suicide and causes immediate banking collapse. Implicit default via inflation is a slow, boiling frog phenomenon that most voters don't understand until it's too late. History shows they always choose the latter. The retirement system is the vessel they use to contain the capital needed to absorb this diluted currency. But how exactly do they keep you trapped in these losing assets without passing a law that says, you must buy bonds? The answer lies in the plumbing of the modern financial system. 3 specific signals flashing red right now that show the trap has already been sprung. You might believe that the greatest risk to your retirement is a stock market crash. But the data suggests the real danger is a market that refuses to crash when it should. A functioning market signals risk through price. If a government borrows recklessly, its bond yields should skyrocket to warn investors away. But in the United States, those warning lights have been deliberately disabled. We are witnessing the anesthetization of the bond market, where price signals are suppressed to ensure the liquidation machinery keeps running. This silence is not safety. It is the evidence of capture. To see the trap closing, we need to look at 3 specific signals flashing red on the dashboard right now. These are not TV talking points. They are the structural mechanics of how your wealth is being ring-fenced. The first signal is the death of the term premium. In a sane world, if you lend your money to the government for 10 years instead of 1 month, you demand a premium for the extra risk. You need to be compensated for the uncertainty of inflation, political changes, and fiscal deficits over that decade. Historically, this term premium was a healthy, positive number. But for most of the last decade, the term premium on the 10-year Treasury has been near zero or even negative. Ask yourself, why would anyone lend money for 10 years for less compensation than they get for lending it for 1 month? The answer is that the buyers are not buying for profit. They are buying for compliance. The market has been flooded with price-insensitive capital, money that must buy government debt regardless of the yield. This leads us to our updated mechanism map, which now reveals the full trap. Excess debt, regulatory capture, the automatic bid, saver liquidation. The intermediary box is no longer just the Federal Reserve. It is now the regulatory framework that governs your own 401k. This brings us to the second, and perhaps most insidious signal, the rise of the target date fund. In 2006, Congress passed the Pension Protection Act. It sounded boring, but it contained a clause that revolutionized modern finance. It allowed employers to automatically enroll workers into qualified default investment alternatives, QDIAs. Before 2006, if you didn't pick an investment, your money sat in cash. After 2006, it went into target date funds. These funds are designed to automatically shift your money from stocks to bonds as you age. It sounds responsible, but look at the mechanism. If you are 50 years old, your target date fund might mandate a 40% allocation to bonds. Every 2 weeks, when your paycheck hits, that fund must buy treasury bonds. It does not matter if the deficit is $2 trillion. It does not matter if inflation is 5%. It does not matter if the bond yield is a pitiful 3%. The algorithm buys. This creates a terrifying dynamic. The US government can be fiscally reckless, blowing out the spending, and the bond market cannot punish them because millions of Americans are structurally forced to buy the debt anyway. You are not an investor. You are the bid of last resort. The third signal is the divergence in Treasury auctions, specifically the tail. When the Treasury sells new debt, it holds an auction. If demand is weak, the government has to offer a higher yield than expected to entice buyers. The gap between the expected yield and the actual yield is called the tail. In a healthy market, tails are rare. Recently, however, we have seen a disturbing pattern of tailing auctions, particularly in long-duration bonds. This is the flicker of the free market trying to reassert itself. Private, discretionary investors, people who have a choice, are stepping back. They are looking at the math, seeing the negative real yields, and saying no, but the auctions don't fail. Why? Because the automatic bid from the domestic captive audience steps in to fill the gap. The data shows that as foreign central banks, like China and Japan, slowly reduce their appetite for US debt, the share held by US investment funds and households is rising. The liability is being transferred from foreign powers to American retirees. We are entering a phase where the fiscal gap, the difference between what the government spends and what it taxes, is entirely funded by the degradation of the currency you are saving. The bond market has lost its vigilantes and replaced them with hostages. If you look at the 10-year Treasury yield today, you are not seeing a market price. You are seeing a regulatory price. A price kept artificially high and yields artificially low by the sheer weight of passive flows that have no brain, no opinion, and no exit strategy. The danger is that you perceive this stability as safety. You see your bond fund barely moving and think, at least I'm not losing money. But remember the lesson of part 1, in a financial repression regime, stability is the theft. The fact that the bond prices aren't crashing is proof that the mechanism is working to slowly bleed your purchasing power into the government's coffers. The trap is now fully visible. You have a government with unpayable debt, part 1, using a 1945-style playbook of negative real yields, part 2. Enforced by a regulatory machine that forces you to buy the debt, part 3. The only question left is, what happens when the math finally breaks? There are specific, quantifiable thresholds that tell us when slow bleed turns into cardiac arrest. We are now standing at the edge of the if-then funnel. The history we have analyzed, part 2, and the signals we are observing, part 3, are not random noise. They are coordinates on a map. But a map is useless without a destination. We need to know exactly when the slow bleed of financial repression turns into the cardiac arrest of a currency crisis, and what you can do before that transition completes. To navigate this, we apply a quantified if-then funnel based on sovereign debt thresholds that have historically triggered regime changes. The base case, 65% probability. The slow liquidation. If the US interest expense remains below 30% of tax receipts, then the current regime of financial repression continues. The government will maintain negative real yields, inflation higher than bond yields, to slowly melt the real value of the debt. The signal. Watch the net interest to tax receipts ratio. We are currently near 19%, meaning 19 cents of every federal tax dollar goes straight to interest. The lag. Historically, this phase lasts 10 to 15 years. We are roughly 4 years into this specific cycle, starting in 2020. The result is a cumulative 30 to 50% loss of purchasing power for savers trapped in standard 60-40 portfolios. The critical threshold, 35% probability. Fiscal dominance. If interest expense crosses 30% of tax receipts, then the Federal Reserve loses the ability to fight inflation entirely. Raising rates further would bankrupt the Treasury, so they must cut rates or print money, yield curve control, even if inflation is rising. The signal, a sudden jagged spike in the 10-year yield above 5.5% that forces the Fed to intervene with their emergency liquidity despite high CPI. The outcome. This triggers the lirification of the currency. The bond market breaks and capital flees into hard assets. This is the 1947 scenario on steroids. This brings us to the final iteration of our mechanism map. We can now label the output clearly. Excess debt, financial repression, the trap. Sovereign solvency via private liquidation. The arrow leading out of the final box points to one place. The transfer. The purchasing power is not disappearing. It is moving from your account to the government's ledger. So, who pays and who benefits? If we strip away the moral language and look only at cash flows, the ledger is clear. The payer, the regulatory captive. This includes anyone holding long-duration government bonds, anyone with a standard target date fund, and anyone whose primary savings are in cash or annuities. You pay via negative real returns. You are the fuel for the engine, the beneficiary, the real asset owner, and the sovereign debtor. The government benefits because its debt is inflated away. Asset owners benefit because scarce tangible assets, commodities, energy, prime real estate, and monetary metals tend to reprice higher in dollar terms as the currency dilutes. This leaves you with a difficult question. How do you escape a trap that is woven into the laws of the financial system? The answer is not to abandon the system, but to understand where the regulatory perimeter ends. The government can easily regulate and capture financial assets, numbers on a screen like bonds and bank deposits. They are easy to ring-fence. It is much harder to capture bearer assets or hard assets that have no counterparty liability. The most sophisticated capital is already moving. We are seeing a quiet rotation out of financials, paper promises, and into industrials and resources, tangible things. This is not about day trading, it is about structural allocation. It means owning the companies that produce the inflation, energy, materials, rather than the bonds that suffer from it. It means recognizing that in a debt liquidation regime, volatility is the price you pay for escaping certainty. The bond market offers you the certainty of a small, nominal return and a guaranteed real loss. The alternative markets offer volatility, but the potential to preserve purchasing power. We are living through the resolution of an 80-year debt supercycle. The 1945 roadmap tells us that the government will prioritize its own survival over the value of your savings. They have the motive, debt, the means, repression, and the opportunity, regulatory capture. The system isn't broken. It's doing exactly what it was designed to do when the debt gets this high. It is harvesting the wealth of the public to settle the accounts of the state. The only variable left is whether you willingly provide the harvest or whether you position yourself outside the blast radius. The repression is the mechanism. The liquidation is the goal. But what comes after the liquidation is complete. When the debt is finally inflated away, the world will need a new monetary standard to replace the diluted dollar. That reset, the Bretton Woods III scenario, is already being architected by central banks behind closed doors. And that is the subject of our next investigation.